Ladies and gentlemen, good day and welcome to PCBL Limited Q3 FY23 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sanjay Jain from ICICI Securities. Thank you, and over to you, Mr. Jain.
Thanks, Nirav. Good morning, everyone. Thank you for joining on for PCBL Limited Q3 FY23 results conference call. We have PCBL management on the call, represented by Mr. Raj Gupta, Chief Financial Officer, Mr. Saket Shah, Head Investor Relations, and Mr. Pankaj Kedia, Vice President, Investor Relations. I would like to invite Mr. Raj Gupta to initiate the call with his opening remarks, post which we will have an opportunity for a Q&A session. Over to you, Raj. Thank you.
Thank you, Sanjay. Thank you, Nirav. And a very good morning to everyone. On behalf of PCBL, I extend a very warm welcome to all of you on our earnings call. I would first like to take a moment to introduce Mr. Saket Shah, who has just joined the group as Head Investor Relations. Saket is an alumnus of Galikar Institute of Management in Mumbai and brings with us over 20 years of rich strategic experience across various industries and functions. Prior to PCBL, he was heading up investor relations and ESG reporting for Grasim Industries. He also had a stint with Citigroup. At the group level, Saket will also be spearheading ESG and sustainability initiatives. Coming to Q3 performance, we reported rupees 1,463 crores in the operating revenue during the quarter. EBITDA for the quarter was rupees 176 crores. PBT and PAT stood at rupees 128 crores and 100 crores respectively. On YTD basis, our revenue from operations was rupees 4,500 crores, while EBITDA stood at rupees 575 crores as against rupees 3,228 crores of revenue and rupees 534 crore of EBITDA during the same period last year. On quarter-on-quarter basis, realization per ton was almost flat. Due to steep correction in crude prices, the formula pricing would correct by over $200 per ton in Q4 over Q3. As a result, there was significant level of inventory liquidation at customers' end, resulting in lower offtake during Q3. Volumes during the quarter were around 1,100,000 tons, down about 10% from the previous quarter. However, due to significant restocking that has happened, we believe part of this volume we will be able to make up in Q4. Also, despite the drop in volume, with our well-spread customer and product portfolio, we could still maintain the overall profit margin. EBITDA per ton during the quarter was rupees 17,357 as against rupees 16,863 during Q2. Commissioning of new cogeneration power plants during the year have resulted in significant debottlenecking of our power capacity, and now we are able to generate and sell more units of power per ton of carbon black production. On a YTD basis, we have generated around, on an average, about 1,338 units of power per ton of carbon black, and this number in the same period last year was 1,148 units. So there is almost 190 units of increased generation per ton of carbon black production. Q3 power generation was even higher at 1,361 units per ton of carbon black. Average realization during Q3 from power sales was rupees. We are seeing an uptick in power tariff in the current quarter with average exchange price of around rupees 6.4 rupees per unit in January, as against an average of rupees 4.55 during quarter 2. Specialty volume during the quarter was around 9,000 tons, which is roughly 8% lower than previous quarter, again primarily on account of inventory liquidation at customers' end. We are getting very strong demand commentary from auto and tire industry, and which is also reflecting in uptake in the current quarter in our industry. So we expect a bit volume-wise better quarter in quarter 4. On the project side, first line of Tamil Nadu is ready, which is roughly 40% of total Tamil Nadu capacity. We are just awaiting approval from some electrical authority to give us startup power. We expect maybe about 2-3 days time before which we can start the trial run. Second line will come up with a cap of about 15-20 days. So ideally by end of this month that line should also be ready, and we will commission the third line very soon after that. But more or less the project is ready, and any one of you, if you happen to be in the line, it will be pleased to host you there. So you can have your own assessment of the readiness of the plant. On expansion of specialty line, out of the proposed 2 lines, first line is in advanced stage of construction, and we expect the line to be ready by March 23. It will be around 20,000 tons line, specialty line. Commissioning of second line should take another year, so maybe by March 24 we will have that line also ready. With this, friends, I open the floor for your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, you will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Aditya Khetan from SMIS Institutional. Please go ahead.
Yeah, thank you for the opportunity, sir. Sir, my first question is on the domestic market volumes. Sir, we are witnessing in this quarter that the domestic volumes have declined by 7% on quarter-on-quarter basis. So are we witnessing domestic demand also has started to falter or has become weak? And how is the current trend for the month of January?
Okay. Aditya, like I said, our volumes during the quarter are around 10% lower compared to the previous quarter, and I expect that there would be a steep price correction between last quarter and this quarter. So, there would be a temptation at customer end to reduce the inventory level. Right.
Earlier, sir, so what you are expecting that the export demand was weak, but now we have started to witness a decline in the domestic volumes also. So just wanted to get an idea how is the domestic market going right now.
The domestic demand scenario looks pretty encouraging. Not only tire and auto companies are manufacturing more volume, they are also exporting more. So both domestic demand as well as overall manufacturing level in India, that has gone up, right? And that is more structural. So we don't see any challenge on the demand side. But if there is say 16-17% price drop between, and we operate in a formula pricing industry, right? So our customers know that by shifting part of their offtake to subsequent quarters, they will be able to procure it more economically. So therefore, both domestic market and international market, there was a volume drop. Now, international market, yes, in Europe there is recession, and therefore there are issues, right? but we have our own strategy. So we don't get caught down by what is happening in the, industry level. It's a pretty big market, and what we are doing globally currently is very small. In international market, the volumes that we do is just about a percentage, less than a percent of the total global demand. All we have to do is maybe knock on more customer doors. That's all we have to do. And we have already invested heavily in our supply chain network. So we are well connected with customers, have very strong presence locally in so many countries. So we don't see this scenario as something which is concerning.
Okay. So for the month, for Q3 FY23, so what I was checking the government data, so when we get the imports of carbon black, so then it was showcasing that imports in India have started to increase on quarter basis. They have gone up by roughly 7-8%. So just wanted to know, so this is particularly from which countries, if you can highlight from China, Russia, South Korea, where we have started to witness increase in imports in India.
Well, first of all, China is not as dominant both in terms of volume as well as in terms of their product offering. So the imports in China in India is far less. I mean, last month it was about 500 tons. Right? So you are right that while level of imports in the interim has gone up, see what happened. I mean, last 1.5 years has been extremely volatile in terms of this war in Eastern Europe. Russia not being able to utilize their capacity because they were selling primarily in Western Europe. And then eventually Indian importers realizing that if they procure from Russia, then they can procure at a lower cost. And incidentally in Q2 and even in Q3, the realization carbon black pricing was very high. We were selling at almost 140,000 rupees per ton. Right? And therefore there was an opportunity for them. So these things will continue to happen. Some quarters will see imports going down significantly. Some other quarters it will move up. But for us, what is important is to hold on to our, own strategy, ensure that we have a fair balance between our margins and capacity utilization. And that's exactly what we did.
Got it, sir. Got it. So now we are witnessing that the carbon black prices have started to decline. So in declining carbon black prices scenario, how does our spread move? Like just an idea if you can give, we can maintain or there is a decline into the spread?
Any change in crude prices upwardly or downwardly should not impact our margin because almost 70-75% of our sales directly or indirectly is linked with cost of raw material.
Mm-hmm.
And therefore, there would not be any margin impact. Margin impact may come from different reasons, other reasons. If we are talking about gross margins, then that can happen. Maybe if there is some kind of inventory build-up in the system, so that can happen. EBITDA level margin can change maybe because of change in some expense structure. So like if fixed cost is moving up or going down. Right? And there are other costs also. But otherwise, plainly speaking, changing crude prices, as long as we are not building on, massive inventory, that should not impact our margin.
Okay. And similar declines, sir, are you witnessing into the CBFS prices also? So just wanted to know, so this price decline in carbon black, so this is majorly because of demand softening or this is a raw material pass-on kind of a thing, what is happening?
It's a raw material pass-on. Previous quarter 3 when we were selling, our raw material was linked with crude at $100. And in fourth quarter we were selling, our raw material will be linked with 85 crude. So it is just a reflection of change in food.
And for the current month also, sir, so for the current quarter also, so you are expecting that the crude prices will remain in this range, $80 to $85, so that could be the range.
3-4 months, crude prices have remained range bound, right, between around $80-$85. So we are not seeing any significant price changes next quarter, as of now. Unless crude changes in February and March significantly.
Got it. So just one last question from my side. Sir, onto the specialty business, so the global growth was so what I was seeing, so that is expected to be around only 3 to 4% in around 2027. But sir, we are confident that the specialty business will grow faster than the normal grade. So how should we look this in context with PCBL?
It is so global. Even if you look at global industry, Aditya, the industry last 4-5 years has been growing at a CAGR of about 6-7%. So that 4-5% number, I don't think that is correct. Number one. Number two, we are a new entrant in this space, specialty space, and therefore we have a smaller portfolio as compared to some of the large manufacturers. Also, our market share is very small. In a 1 million ton market, what we are doing currently is about 40,000 tons. Right? So it's a very small market share. We are yet to, create a larger portfolio, and we are yet to connect with a number of more customers. So that's an opportunity for us, and that's exactly what we are doing. And therefore, we believe that next 4 to 5 years is going to be a rapid growth period for us in specialty.
Okay. Okay, sir. Thank you, sir. That's all from me.
Thanks, Aditya.
Thank you. Next question is from the line of Arthur from ICICI Prudential. Please go ahead.
Yeah, hi, sir. Thank you for the opportunity. So basically, just on the previous question, just wanted to recheck in terms of inventory impact, if you can help us understand, given you said there's some decline in formula pricing, etc. So should we expect some kind of inventory valuation related impact going ahead in the coming quarters?
No, Arthur, nothing significant because we don't increase inventory levels. We have a fair visibility around how the crude prices are moving, and the formula price works with a quarter lag. So it is not something which happens suddenly for us. We knew that this price, because there is a 1 quarter lag, the prices are going to drop cheaply, and there will be tendency for our customers to shift part of the procurement to next quarter. And accordingly, if you look at our production number, even the production has gone down in sync with our sales volume. So we have reduced about 105,000 tons as against 101,000 tons of output. So just 4,000 tons, and that is built because we wanted to make up volume, part of the lost volume in quarter 3 and quarter 4. Right? And we believe that quarter 4, considering the overall demand scenario plus the order book that we have, we believe that this 4,000-5,000 tons is an additional volume that we can take during the quarter. Over and above our normal volumes, which has been, earlier, like 100-1,500 tons. So that's how we are looking at quarter 4. So no significant impact of inventory.
Sure. And second question on, in terms of margin, like if you see, gross margin per kg or EBITDA per kg, which we have reported. So broadly, one should expect similar trend even in the near term, like, or should one expect some more normalization, say next 3-4 months, given where the pricing has moved?
In our earlier calls also, we indicated that because of all the initiatives the company has taken on portfolio building, manufacturing efficiency side, we believe that structurally there would be a change in our margin profile. And we took 2022 as base, the full year number as base. And we believe that in next 4-5 years, on an average, every year there should be about 1,000 rupees kind of increase in our EBITDA performance. And we stick to that. So in some years, maybe that will be a little more. In some other years, it will be a little less. Quarter on quarter, there can be some kind of fluctuation because this entire macroeconomic condition we are in currently, that itself is extremely volatile. Like demand scenario, supply scenario, everything is changing so rapidly. Between quarters, there can be little up and down, but trajectory-wise or direction-wise, I think we are on the right path to reach what we, communicated earlier.
Fair, sir. Thank you so much.
Thank you, Arthur.
Thank you. Next question is from the line of Riya from Equitas Investments. Please go ahead.
Hello. Hi. Thank you for giving me the opportunity. My first question would be in regards of, since we've seen that 0.5 million ton capacity is coming up in domestic for all the players, and we're seeing that export demand is also decreasing. how do you see that going forward, the domestic demand will make up for the incremental supply as well as decrease in exports going forward? And where do you see this coming from?
Well, yeah, there are two, three things which we will have to understand here. Yes, supplies have come up, new capacity has come up, you are right, about 500,000 tons. But if we go 2 years back, and if you look at where China was in terms of capacity and where they are today in terms of their capacity and production, they have created a massive vacuum on the supply side, and this is far bigger than that 500,000 tons. So in a normal steady state, the market will remain undersupplied, right? That's number one. Number two, while we are only looking at destruction of demand in Europe, right? We are talking about recession and all. So we are still not at Europe, but we are talking about maybe a possible recession scenario in Europe. What has also happened simultaneously is energy prices have gone up significantly in Europe. And therefore, the level of manufacturing in Europe will also go down. And while their overall consumption might go down, but because their manufacturing level will also should go down, I mean not will, but should go down. So Europe should also import more from other countries, and that's an opportunity. Right? So we don't believe that overall potential for Indian export is going to go down, despite whatever we are talking about Europe and western part of the world. So that's one. Second, India is certainly producing more and selling more. So domestic demand remains lower, and India's export share across the whole chain, not only in carbon black, but also in auto and tire, even that is going up. So we believe that this production will be well supported by adequate demand. And while there can be periods when when capacity comes up, markets look maybe a little oversupplied, but between the next phase of capacity expansion, you will see that capacity gets utilized. So, like when we also commission this Tamil Nadu capacity, we are not saying that in year one we will be able to utilize it fully. But what we told earlier also that we feel that in 2 years' time we should be reaching peak utilization. And therefore we are already now working on some brownfield expansion planning. So we don't see demand as a challenge, but capacity utilization will be a challenge for us going forward.
And for export, like you said, Europe can be a opportunity if things go the other way. Where else do you see export? Where do we see a decline which came in this current quarter, and where do you see opportunity coming forward in terms of exports?
This current quarter was not a reflection of demand scenario changing in Europe. Honestly, even now, when people are talking about recession in Europe, it is not reflecting in their consumption. And therefore, in current quarter, we attribute this volume drop primarily to the price correction, which is expected between quarter 3 and quarter 4. So it is not only Europe, it is across geographies. Again, in India, we saw the same thing. But then again, the restocking which happened is going to support higher volume of take in the current quarter.
So basically, I'm talking about 30,000 production of carbon black which we did for exports this year, 29,098 versus 39,000, almost 40,000 last year, and almost 36,000 the previous quarter. So you're seeing a 20% decline on a QOQ basis. So where is this decline coming from in export volume?
It is across geographies. Europe, in any case, is just about 20% of our overseas volume. As of now, Europe is not very big for us. Almost 75% of our volume are still sold in Southeast Asian countries. So Europe strategically is important. Europe strategically is important for us because we believe that going forward, because of changing trade relations, China producing less, Russia becoming kind of blacklisted for them, it creates a bigger opportunity for India. So that is structural change in the relationship, trade relations. But our portfolio is less spread. We are present in 45 geographies. And we are adding what we are doing as a part of our strategy because we have seen like what everyone is talking about, and if that comes true. So we also know that we need to create a strategy where we don't depend on any part of the world in a big way. So our strategy is to maybe knock on more customers' doors when we see demand softening in some part of the world. And like I said, that we have invested heavily in our supply chain network capability. We have created a lot of offices, warehouses, decanting stations, even R&D center outside India. As a lot of people engage with customers.
Right. And in terms of China and us, what is the spread currently, the different spreads in, at what would be the break-even for them to surpass our pricing?
To answer your question, it is still more than $300. I mean, Koza remains $300 plus higher. But,
Hello?
yeah, China, feedstock prices remain $300 higher as compared to our feedstock. But, yeah, I think the time has come when we should stop looking at what China is doing in carbon black space. They are no longer a dominant force in our industry. This is reality. God willing, in 2 years' time, we will be competing with them and will be giving them a tough competition in their own geography.
Got it. Then where are we seeing the higher imports coming from, and do we see it coming down this quarter?
Mostly it is Russian material which is getting rerouted in India, some directly come through Middle East countries.
Okay. And in terms of specialty, since we saw some inventory liquidation at customers end this quarter, do we see those volumes of 11,000 coming back again next quarter? Like, when do we see such kinds of volume?
We are hopeful it will come back in this quarter.
Okay. There's no demand issues in specialty, right?
No, there is no demand issue. And as I said, that we are still very small. So for us, next 5 years, growth should not be a problem.
Okay. Thank you.
Thank you.
Thank you. Next question is from the line of Bharat Sheth from Quest Investments. Please go ahead.
Hi, good morning, Raj and Saket. Raj, in QOQ, despite decline in the quantity, we have been able to improve our EBITDA margin. So what has led to this is a structural change which we were talking is help us in improving the EBITDA margin?
Bharatji, good morning. First of all, being the biggest player in the industry, domestic industry, we have to act little responsibly, and therefore when we saw supplies coming up, the little softening on the offtake because of price correction, we behaved responsibly and did not start a price war. Right? That's number one. Number two, a good part of our other expenses is also variable. So when volume goes down, then our expenses also go down. Third, what contributed to better EBITDA is there is a significant drop in freight cost. Freight cost has, it was very high in quarter 1, quarter 3, has dropped significantly down in quarter 3. Right? And it has almost come back to that pre-COVID level now. And consequent to that, we could still maintain better EBITDA profile, despite this volume drop.
Okay. So again, in Q4, YOY, there would be a significant improvement in EBITDA because last year we had a very high logistic cost, correct? Is that fair understanding?
Yeah, last year's logistics cost, was on a upside move, whereas this year it is on declining mode.
Okay. So now coming to the specialty business, Raj, see, we were expecting around 45,000 crore, 45,000 ton in initial, first part of our estimate, which now whereas we are roughly around 29,000-30,000. So how do we see, and then going back from 45 to 54, that medium term projection that we were looking. So where do we stand in that, and how many number of products we have been really able to aid during 9 months?
Bharatji, first of all, I would say that more or less we are on track. I understand that initial guidance was around 45,000. But when we started the year, the global growth outlook was at about 3.5%, GDP growth rate. Today it has already come down to 1.5%. It is more than 50% decline in GDP forecast for current year, which is 23. Sorry, 20. Now in that scenario, if you look at our run rate, it is still better than last year's run rate. Third quarter, what is happening, the volume loss which is happening, roughly 1,000 odd tons, it is primarily on account of the price correction. And it is not our ability to sell. That is there. And therefore we are confident that when we ask whether we'll be again be able to get back to that 11,000-12,000 tons kind of a run rate quarterly, we feel optimistic about that.
So is that fair understanding? Roughly we will be able to order around 40,000 to 41,000 tons for 23.
I feel so.
Okay. And now coming back to, then again going back to, we were talking of additional 10,000. So then it will remain around 50, 51 rather than 54. Is that fair understanding for 24?
See, as I said, market conditions are extremely volatile, right? And therefore, it is not that once we have lost some volume in one quarter, we cannot make it up in subsequent quarters. Okay. As of now, I am not giving any indication about next year. Let's walk through the next quarter also. I think end of the year we will be in better position because then we will have clear visibility around our order book. So I think with more conviction I'll be able to give you a right. But we feel confident about our specialty journey. We are launching newer grades, we are adding specialty lines, we are adding specialty customers. So we don't see any challenge.
So how many new products we have been able to, and now currently what is product portfolio and where do we see in 2-3 years time?
Every year we have been launching about 90 new grades. I think that should be our minimum, pace of launches. As of now, we have close to about 50 odd products in our portfolio.
Okay. And is that fair under, again, new products, generate a better margin than the current one?
Not necessarily, right? Some of these grades will be a little higher on the value side, but the whole idea is that we keep on creating newer solutions for our customers. Because what is special today, eventually in 4-5 years time, it will become commodity. And therefore we will have to constantly do research, constantly create something which is more meaningful for our customers than what today we have.
Okay, last question, the commissioning of this new Tamil Nadu plant will have some kind of because of lower utilization fixed cost, so our EBITDA may not be high as well as interest cost may also go up.
We don't have significant borrowing in Tamil Nadu, so interest cost will not be much, number one. Number two, because this plant is based on the latest technology, we expect our overheads to be also relatively lower in this company. It's a new experience under which we are developing this greenfield. And therefore, I don't think that should be a concern, and we don't see a challenge around utilization of capacity. So like we said that in 2 years' time, possibly we should be utilizing it fully.
Okay, fair. Thank you and all the best, Raj.
Thank you, Bharati.
The next question is from the line of Sanjay Jain from ICICI Securities. Please go ahead.
Thank you. Good morning. Thanks for taking my questions. First on the demand side, particularly demand supply dynamic in domestic. For the export market, it's us who have been dominantly established by the capacity addition which is coming by the two of our competition is largely catered to the domestic market, and so we have highlighted this earlier as well that they don't have a meaningful export presence. Will this create a sort of imbalance in terms of demand supply situation in India? That's number one. Number two, will it have any pressure on relooking the business model in the domestic where we last 5 years has been a phenomenal for us in terms of cost plus basis? Do you see risk in terms of your cost plus basis in the situation where we expect for next 2-3 years at least there will be an excess supply? That on the domestic market side. Second, on the feedstock side, we have seen India importing almost one-third of the crude oil requirement from Russia. Are we also looking to import more CBFS from the Russian market, which gives us some sort of a cost advantage in terms of the raw material procurement? Are we doing it? Is there on the card? So these are two my initial questions. I'll come back for more questions.
Okay. Just to answer your first question first, we consider the whole globe as our market, and while India remains the largest market for us, but so far as our own strategy is concerned on capacity utilization side, we don't depend on any geography, including India, in a big way. In the interim, capacities have come up, and because these players don't have, that bandwidth to export more or sell more in the domestic market, obviously they will try to keep, domestic market as their source of utilization. And we are well aware of that, right? And this quarter also you will see that therefore we behave responsibly and, we allow to strike that balance between volumes and margins. Speaking of how we are looking at the overall demand supply scenario, the space created by China is very big, right? And globally that has to be filled up, whether the capacity comes in India or somewhere else. So while there can be a redistribution of supplies, demand and supply, but from overall supply and demand perspective, we don't see, a scenario where market is oversupplied, right? Number two, the level of carbon black manufacturing in Western Europe is also going to slow down because of higher energy prices and all there. And consequent to that, we don't feel that we will not be able to utilize capacity. In fact, so far as our international contracts are concerned, we signed this contract sometime in November, December. These are calendar year contracts, and we have a good order book in international market. Right, so we have visibility around that. Coming to your question on the feedstock import side, we explored the possibility of, establishing, procurement relationship with Russia. Problem is, the quality that we get currently in US Gulf Coast, that quality is far superior than what is available in Russia. Number two, the logistics cost of bringing Russian material to India is, even now, it is very expensive. And it will eat up most of the gain that we get on the pricing side. So, and there is one more, practical problem, which is currently it is very difficult to get insurance on ships which are carrying Russian material. So with these three problems, as of now, it looks tough. And commercially also it doesn't make much sense for us.
Got it. One follow-up on the first answer. Is it fair to assume, the way you have explained, our mix in terms of domestic and international is going to significant change in next 2 years, because while domestic market is oversupplied, export market looks a very interesting positioning. So is it fair to assume that a lot of incremental capacity will be sold in an export market? In such a scenario, do you also see risk to the gross profit per kg? Because historically we have seen that export market has been at a slight discount to the domestic market. Do you see that also panning out along with it? That's my first question. Second, on the power side, with all this power capacity coming up, how much more power at a peak utilization that we can sell? As in incrementally, how much more units can be sold from the increased capacity, and what is the capacity sold today? So these are the two questions.
Last 3-4 years, Sanjeev, our margins in international market have been almost parity with domestic market. So sometimes domestic margins are sometimes international margins, but if you look at average margin generation from domestic and international segments, this is almost in parity. So therefore, there is no reason for us to think that when we sell a little more in international market, it is going to impact our blended margin. Right? Coming to power generation side, like I said, that we are generating more number of units per ton of carbon black production because of debottlenecking which we have been able to carry out. And we believe that our quarterly run rate of power sales, which was last year, I mean, if you look at full year number, it was about 76 billion units per quarter. It has already increased to 90 billion units per quarter. We believe we can, gradually take it more towards 100 billion units per quarter. So based on our current capacity, I'm not considering Tamil Nadu capacity because that will be separate. Based on our current capacity, we can go up to maybe a run rate of about 100 billion per quarter.
So another 10% from here is what we can see upside in terms of the power unit sales. Got it. One last question to sum up from all the earlier answer you have said. So it is fair to assume that next year, whatever has happened, assuming the situations being stable, we should be able to add 50,000 metric ton on a standard carbon black and another 10,000 metric ton on the specialty. That would be a fair assumption?
Fair to assume, but like I said, that maybe in couple of months' time when we are through with our budgeting exercise, then we will be in a better position to give the guidance. But it looks really reasonable.
And the gross profit sustaining at these levels doesn't seem like a risk to us, right?
In a steady state scenario, no. We don't consider anything.
Got it. Thanks, Raj, for all the patience answer and best of luck for the coming quarter.
Thank you. Next question is from the line of Dhiral Shah from Phillip Capital. Please go ahead.
Yeah, good afternoon, sir. Thanks for the opportunity. So what is our debt position as on December 2022 in terms of long-term and short-term debt, as our finance cost has risen sharply in Q3? And how do we project by March 2023?
Debt on a standalone basis has not gone up. It remains where it was last year end. It was around 684 crore long-term, short-term all included. Out of that, long-term was around 300 odd crore. This was working capital. So debt levels have not gone up. But what has happened there is between March last year and now, US Fed rates have gone up by 425 basis points. Even repo rate has gone up by 225 basis points, from 4% to 625. Right, and the spot market borrowing rate, the commercial paper, etc., that has gone up even cheaper. Right, so roughly on an average about 3% interest rate. If you apply that 3% interest rate on our debt rate of roughly 700 odd crores, that converts into some 21 crore for the full year. Right, for 9 months that will come to around 16-17 crore, and our increase in interest cost is lower than that. So it is only the change in interest rate scenario which is reflecting on our borrowing cost, but per se that level of borrowing has not gone up. While we have given a guidance that our peak borrowing may be around 250 odd crores more compared to last year, but somehow we have been able to manage with the same level of rate.
Okay, so by March also we see this level of 700 crore kind of a debt?
Yeah, we feel it will be somewhere here, maybe 15-20 crore here and there, but more or less. I mean, there is no significant change in debt profile that we are seeing on a standalone basis.
Okay, and so on the Chennai plant particularly, since we are almost ready with the 2 lines, so how much volume we expect in current quarter from these 2 lines?
From current quarter, whatever we sell, that will be like, against the trial runs, etc. So maybe commercial quantity may not be much in the current year. Whatever we sell will mostly be towards getting the approval, etc. from the customer. So no commercial product impact on the revenue side.
Okay, so from maybe Q1 we'll see the commercialization.
Yeah, because the plant is in the process of getting commissioned, like the lines will come up gradually, and then we have to go through the process of approval from various customers. So therefore, there will not be any commercial supplies as such in the current quarter. Small quantity may be there, but we are not considering that.
Okay. And so if I look at our performance chemical business particularly, and what I understand that majority of our sales is on spot basis. So what explains the decline in the volume?
Again, like I said, that the price points are different between quarter 3 and quarter 4. And this market is very fragmented market, small customers making up this volume. So for them, this pricing is even more lucrative. Right? So I mean, other than that, we don't see any structural change in the demand scenario.
Okay. Thank you so much, sir.
Thank you. Next question is from the line of Radha from B&K Securities. Please go ahead.
Hi, sir. Thank you for the opportunity. So, my question was on the performance chemical side. So given that performance chemical, the user industry for this is the industrial hoses, conveyors, agri, pipes, etc. So is there any numbers that you track to track the volumes of performance chemicals for our business? Any industry numbers?
Primarily construction industry, like you said. So this performance segment is more linked with construction industry. So generally when construction industry does well, then there is better offtake for this. But for us, rather, I mean, our focus is on the holistic basis, like on the overall capacity utilization. So whichever segment we see opportunity, we try to move more material. This performance segment actually we created to get greater flexibility in terms of our offerings. So we created a number of grades which are not, which doesn't have an application in rubber or tire, but in different industrial applications. So it was kind of, to offer us a flexibility to move between different kind of customer segments when we see changing market scenarios. So therefore, it can happen in some quarters that our tire volumes are increasing, some other quarters performance volumes are increasing. What is important for us is to ensure that we operate at a higher capacity across different markets.
Understood, sir. And sir, lastly, how many grades have you launched till now in specialty for 9 months FY23? In the next 2 years, how much can you launch?
I will not give you a specific number, but every year we have been launching about 9-10 grades rather, and end of year when we publish our annual report, we will get the grade-wise reflection of what all we did. But this year also be a similar kind of a year for us.
Okay. Thank you, sir, and all the best.
Thank you. Next question is from the line of Jessica from Nuvama. Please go ahead.
Yeah, hi, sir. Good morning, and Mr. Rohan this side. So a couple of questions. So first is on our new capacities commissioning. So do you see that when we go in full commercialization from Q1 onward, or maybe on Q2, do we see any margin pressure or a realization pressure in the market, or we think that we have already created enough orders to meet these additional capacities?
We don't see any such challenge. And like I said, that this plant should have better efficiencies compared to all other plants. It will come up in a new technology. Right? So overall efficiency, cost-wise and manufacturing-wise, it should be better. So somewhere that should make up for, even if we have to maybe give away something on the margin side, that should make up. So we don't see any impact of the market conditions.
Okay. So you think that realizations in the market will not be under pressure with the additional capacities coming in?
We don't see that. We don't see that.
Okay. So second on this, the new capacities, so there also in terms of that, the performance and the specialty black, the output range will be similar, or initially it will be first starting from the rubber black and then we going forward only will be slowly moving to performance and specialty?
You're talking about Tamil Nadu or Tamil Nadu as of now, we are only coming up with tire and performance capacity. There will not be any specialty capacity in Tamil Nadu. The first phase.
Okay. So I was saying that, how do you see that the capacities of the greenfield plant in Tamil Nadu will move forward towards performance and specialty over next 2 years to 3 years, and how it will move?
As of now, our next phase of expansion would come up in Mundra, not in Tamil Nadu. So we'll have to do some work around supply chain if we have to create especially capacity in Tamil Nadu. Specifically, we talk about that. Performance, of course, we will produce in China. And again, like I said, that for us, what is important is to ensure a higher capacity utilization. So whatever opportunity is there in performance or in tire, will try to create a, proper mix in the two.
Okay. And sir, you also mentioned that due to steep correction in crude prices, the formula link pricing which we have, so realizations definitely will come down from Q4 onward, right? So, so will it have, do you see that our margins will definitely remain intact, or because we generally have a EBITDA per kg margin intact, or you see that with the fall in prices, there will be some impact on margin as well?
So, like I said, movement in crude prices or raw material prices or even realization is linked to that. It will not have any impact in normal scenario. I would not comment on fourth quarter margin, right? But like I said that our guidance remains intact that in the next 5 years time because of all the measures that we are taking internally. Gradually there should be an upward movement in our margin.
So in EBITDA per ton, generally, which we have in 9 months, roughly 17,000.
In some quarters it can be less, some quarters it can be a little more. But like if you look at 2022 and if we take a direction towards 2027, I think we are on track.
Okay. Okay, sir, that's it from my side. Thank you.
Thank you. Next question is from the line of Peter from Kisima Wealth Management. Please go ahead.
Hello, sir. So that Mundra plant, the first line is commissioned or the second line is in process? Can you throw some light on that, sir?
First line is in advanced stage of construction. We believe that by end of current quarter, we should be able to do the commissioning. And second line will take about a year time more. So maybe by March 24, it will come up.
And sir, we missed the volume. So can you give the volume split for domestic export and by the tire specialty and performance?
Yeah, sure. It is here in the investor. Can you take it from here?
Oh, okay, sir. And so in terms of export, so which are the top 3-4 export countries by market share for you, and what is the demand outlook in those respective regions?
Well, our exports are well spread, so we have, market presence in more than 45 countries now. And it's fairly spread, so no single country accounts for more than 7-8% of our volume. But we are very strong in countries like Japan, Indonesia, Vietnam, in the Southeast Asia side. On Europe side, we are supplying to countries like UK, Netherlands, Italy, France, Germany. So it is well spread, basically. And demand outlook, like I said, that domestic demand outlook is pretty encouraging. Even international, while demand growth may not be, very high in this market. So one interesting thing that we noticed is while most of the economists are talking about a slowdown in Europe and their GDP growth is going down. But if you go to some of the global auto and tire industry reports, they indicate an uptick in the domestic demand there in these geographies. Right? So Europe is likely to, their auto industry and tire industry is estimated to grow at a higher rate than what it was in the previous. Right? So from that perspective, I think market, we expect a very stable kind of market. And then, because currently we are very small in national market, the market is very large. We don't see any kind of challenge in being able to utilize our capacity.
Okay. And sir, this you mentioned, it was mentioned that there's an availability of low cost products from Russia, and including you, many other Indian players and global players have increased production. So there seems to be oversupply. So how much pricing pressure can we expect in FY14 and FY24 and 25? So from the current levels, how much can the price fall? Also, given that crude prices are coming down.
So Russia are things you have to understand one thing. First of all, Russian suppliers are not new in the market. When you look at the global market, Russia in any case was producing. But there was a time earlier migrated to the Western world, Western Europe. Now because there is a relation issue there, therefore they are trying to put their material in other markets, including in India. That's number one. What is important here is when people import in any country, there is a time lag between their placing the order and their eventually getting them. Now, in a fluctuating crude scenario, especially when...
Sir, sorry to interrupt you, but your voice is not coming clear.
Okay, could you clear first part I was talking about? Hello?
Yes, sir. Yes, sir. Time lag you mentioned.
Yeah. So I was talking about the time lag between one placing the order for imports and then eventually, imports happening. Now, last quarter, whichever customers placed order for Russian material, they will have to buy at a significantly higher price than the prevailing price. There is 15-70% price correction between last quarter and this quarter. And importers understand that. So it poses a risk before them. So whether to import in such a, fluctuating price scenario or to depend more on domestic supply. So this quarter, therefore, in the first month, we have seen significantly lower imports in India.
Okay. So in terms of pricing pressure, so going forward, like from the current highs, how much can the price correct for next
fiscal year?
year?
I think pressure because from a global demand supply scenario, I think there is a fair balance between demand and supply. The market is not oversupplied, and therefore it is unlikely that there would be pressure on the margin side. Pricing would be a reflection of change in crude scenario.
And sir, you mentioned that there is a possibility to visit the Chennai plant. When is that, sir?
Sorry, you'll have to repeat.
You said that there is a possibility to visit the Chennai plant.
Yeah, you can visit it. You can coordinate with the IR team, and maybe you can.
We can do it. And finally, sir, just last question. So what is the CapEx plan for FY24 and 25?
Our current CapEx program is coming to an end. Most of it. There will only be one line left in Mundra after the current phase of expansion. But then we have also acquired, small pieces of land adjacent to our existing facilities. The whole idea is to do some brownfield in the interim. So next 2 years, FY24 and 25, we might undertake some brownfield expansion. But as of now, that plan is not ready with us. Right. So once we finalize that, then we will come back with more details on that. But our current CapEx program is coming to an end.
Yes, that is true. And sir, what is the current capacity utilization you are on?
In last quarter, we were around roughly 82-83%.
And this quarter, sir?
This quarter it should be better.
Huh.
Should be better.
Okay, thank you so much, sir. Best of luck.
Thank you.
Thank you. Next question is from the line of Varshak Shah from Envision Capital. Please go ahead.
Yes, sir. Thank you for taking my question. So what kind of investments will we need to make in specialty?
Varshak, sorry to interrupt you. Can I request you to speak a little louder, please?
Yeah. Is this better?
Yes.
Thank you. So what kind of investments will we need to make in terms of ramping up a specialty utilization more from the R&D and adding newer grades?
So on an average, we are spending about 15 to 20 odd crores on R&D every year, and this spending is going to increase from here. We are adding more number of people, and also we are undertaking some projects, not only on product launch side, but also on creating a new kind of manufacturing process. So,
okay. And any further expansions along in terms of capacity?
Like I said, currently we are running this greenfield. Once it is over, then there is some brownfield expansion which is happening on specialty side. And after that, we intend to do some small brownfield in Mundra and Chennai. But as of now, we have not finalized the plan. So when we finalize, we'll come back to you.
All right, sir. Thank you for taking the question.
Thank you. Next question is from the line of Sachin Kasera from Swan Investments. Please go ahead.
Yes, sir. What is the current CapEx which is pending to be spent from the current ongoing that is already announced?
We have about roughly 100 odd crores against our brownfield expansion and roughly around 250 odd crores on Tamil Nadu. Now, when I say 250 crores, this also includes retention, money which is released after relax, based on performance and all. Yeah. That is more of a cash flow side, not actually from, pending orders perspective.
Sure. My question was also more from the cash flow side. So, fair to assume that March will be the peak debt? Where do we see the debt peaking out? Is it the December end debt that you mentioned, or where do you see the debt peaking out? Q4, Q1?
July, we have taken 250 crore worth of borrowing, right, as part of project funding. So it is more or less going to be, the same level, other than maybe working capital once we start operation, small working capital. And on a standalone basis, we would be more or less where we were last year. I'm talking about March 22 versus March 23. It should be more or less similar level.
My question was more on the console side. So console side, what is the level at which you see the debt will peak out?
Console side, it will be only that incremental Chennai loan up to 50 crore, more or less.
Okay. But then once the line commission, while the capex will be over, we'll also need some funds for working capital, right? As the rate of the volume.
That will not be significant. Chennai is just about 25% of our existing capacity. And if you look at PCBL on a standalone basis, our total working capital borrowing is just about 400 odd crores.
So fair to assume that in FY24, our console debt at the net, or maybe let me even say the net debt on console basis in FY24 end should be lower than what we end with FY23?
I'm not commenting on that, Sachin, because one thing we need to understand, our business and working capital requirement also depend largely on crude level. So tomorrow if crude comes down to 40, yes, what we're saying possibly it will be that kind of a scenario. If crude moves to 120, then that will be a different kind of scenario.
But then crude remains at the current level, sir.
Yeah, but even with borrowings and all, Chennai borrowing and all, if you look at leveraging ratios, it's hardly there. Even with that, it will be 0.3 leveraging, what we're talking. There's hardly any leveraging, the consolidated level also, and including working capital.
And one thing on the return ratio, sir, you mentioned that on an average, you're looking at 1,000 rupees per ton EBITDA improvement on an average, every year, some year less and more. So in that scenario, how do you see your return on capital employed moving up in the next 2-3 years from the current level?
Once we are through with our CapEx program, then obviously, the ROC should be somewhere closer to about 20%. Currently, we are incurring CapEx, therefore, the return ratios are looking a little lower.
Sure. Thank you.
Yeah.
Thank you. Next question is from the line of Anik Mitra from Finrata Research. Please go ahead.
Yes, thank you for taking my question. Sir, most of the questions have been answered. I have a question like, what was the price of carbon black last quarter and what is current scenario?
Last quarter average realization was about close to 140,000 rupees, slightly over that. Right, and this quarter it will be around 17,000-18,000 rupees lower.
Okay. And sir, due to poor audio quality, I could not understand the inventory situation, if you can please repeat.
I could not hear properly.
Sir, what is the inventory situation? I actually missed out due to poor audio quality.
Inventory situation? Okay. Inventory, as I said, that we have not built up. We have not built up, any significant inventory. So it is aligned with, usually what we retain. We have just built up about 3,000-4,000 tons of extra inventory to support our higher volumes in current one.
Okay, got it, sir. Thank you so much.
Yeah.
Thank you. Next follow-up question is from the line of Aditya Khetan from SMIFS. Please go ahead.
Sir, thank you for the follow-up. Sir, continuing with the
Aditya, sorry to interrupt you. You're sounding very distant. May I request you to speak through the handset?
Hello? Yeah, now it's okay.
Sir, can I request you to speak through the handset? It's still sounding distant.
Hello?
Yes, thank you. Go ahead.
Sir, continuing with the earlier participant question, sir, onto the inventory side, sir, how is the inventory with the tire players right now? So they are at the nominal level or still they have some 1-2 months of inventory in hand?
You're talking about inventory level, Aditya?
Yes, sir. Yes, sir. At the tire players level.
Sorry? Inventory level, no?
Position, sir, at the tire players end.
Inventory position at the tire players end? See, last quarter there was significant restocking at their level. And while I don't have exact numbers, how much quantity they are maintaining currently, but it is reflecting in the higher offtake. So they are trying to rebuild that.
Okay. Sir, one more question on to the Chennai plant. Sir, what we were told that the Chennai plant have a benefit of additional yield. So can you explain, like, as compared to our 4 plants, how much is the additional benefit of yield which we will get into the Chennai plant?
No, I did not mention that, Aditya. I said that in terms of number of parameters, both on manufacturing side as well as on cost side, this plant should be more efficient. One, because it is coming up in the latest industrial technology, and second, because it is a new plant, so there will not be any baggages that will be carrying here. Right, but exact assessment of the yield, etc., I think the manufacturing team, we don't publish this exact yield plant price and all.
Okay, sir. Got it.
Thank you very much. On behalf of ICICI Securities, we conclude this conference. Thank you for joining us. You may now disconnect your lines. Thank you.
Thank you, Nirav. Thank you, everyone.